thank you everybody for attending today's podcast. And Randy, thank you for the introduction. And again, I'm tax attorney Robert Hoglund, and I've been helping small businesses throughout the country since the inception of the employee retention tax credit. And I think we'll just start off with, what is the employee retention tax credit? Well, it's a government program in nature, very similar to the PPP loan, the Paycheck Protection program, and that is it allows small business owners to get a tax credit based on a percent of wages that they paid their employees for the periods for qualifying businesses under the employee retention tax credit for small businesses for quarters 2, 3, and 4 of 2020 and quarters 1, 2, and 3 of 2021. And the employee retention tax credit for companies, small businesses that qualify, actually it's a check that's issued right from the IRS based on a percent of wages, again, that small business owners have paid their employees for that period. These employee retention tax credit can be very lucrative for businesses, and that being to put more money back into the pocket of businesses that had adverse effects relative to COVID, to keep them healthy, keep employees retained, keep that business going. The employee retention tax credit, now on this note, before I move on, could end as early as tomorrow. There have been some proposed budget cuts relative to our new congressional budget that could throw the employee retention tax credit, end it again as early as tomorrow, and maybe next week. It could be next month. It may be removed from any proposed tax cuts as well. But we'll discuss that a little bit later at the end of this program. So the employee retention tax credit, can we go to the next slide here? Thank you. There are, in order for a business to qualify for the employee retention tax credit, one, you have to have W-2 employees, part-time or full-time, during the period of 2020 and or 2021. And the employee retention tax credit, you have to have and be in business in the territories or states of the United States. You can't be a foreign corporation or anything of that nature. And there are a lot of misconceptions about the employee retention tax credit. Some people think that they just don't qualify because they didn't have substantial losses. You don't have to have substantial losses. There are a lot of rumors going out there. For example, when the employee retention tax credit first started, if you had a PPP loan, it was forgiven, you no longer qualified. Well, they changed that rule where you do qualify. There's been 8 other major changes in opening up the bucket for more businesses to qualify. So there are 2 tests to determine whether you qualify under the employee retention tax credit. One test is the revenue reduction test, and then there's another test called the nominal business impact test. And you qualify per quarter for a business to apply for the employee retention tax credit. And again, that's quarters 2, 3, and 4 of 20, quarters 1, 2, and 3 of 21. And when I personally vet clients to determine whether to qualify, you can take all the quarters or none of the quarters or just several quarters, whichever one is a good fit. So you have a very good claim for the employee retention tax credit. Now, that being said, the eligibility for the employee retention tax credit, when it first started, the only test that was available was the revenue reduction test. And in a nutshell, what that test is you had to have a 50% reduction in gross receipts or revenues comparing quarters 2, 3, and 4 of 2020, 2, 3, and 4 of 2019 compared to 2, 3, and 4 of 2020. In other words, for example, second quarter of 2019 compared to second quarter of 2020, you have to have more than a 50% reduction in revenues to qualify under the revenue reduction test. Same with quarters 3 and 4, comparing 19 to 20. Now remember, you're also could qualify for quarters 1, 2, and 3 of 21. Now under the revenue reduction test, you only have to have a 20% reduction in revenues comparing 19 to 21. So for example, first quarter of 2019 compared to first quarter of 2021, if your gross receipts had more than a 20% reduction, then you could qualify under the employee retention tax credit. Same with quarters 2 and 3 of 2021. You have to have a 20% decrease in revenues as compared to the same quarters of 2019. Now, the revenue reduction test is pretty harsh. And when the employee retention tax credit first started, the first 6, 8, 10 months or so, the government thought that there weren't as many businesses that qualified under this gross receipt reduction test. So they came up with a second test called the nominal business impact test. And you can use one test or the other per quarter to qualify. Now, the nominal business impact test is about a 136-page guideline from the IRS. Now, the IRS are the ones that manage these programs, determine if you have good claims or bad claims. They're the ones that issue the checks, etc. And we'll get to how you apply for the program with the IRS. But getting back to the second test, the nominal business impact test, is whether there were, in each one of the 6 quarters you can apply for, government mandates, COVID mandates, rules, not guidelines or suggestions, but rules that a small business owner's employees, clients, patients, vendors, or otherwise would have had to follow, which would have just a titch more than a nominal effect on that company's ability to garner more gross receipts than they would have without the mandates. And some of these adverse effects under the nominal business impact test, we've broken it down to about 16 major categories of problem and effect. Could be, for example, a restaurant that had social distancing rules. You had to keep tables 6 feet apart or otherwise. Well, under that scenario, obviously you can't have as many people in your restaurant as you would have without the mandates. That's one of the many elements of the nominal business impact test, is problem and effect relative to the mandates. Supply chain issues. If you're unable to get products, if products were delayed, which delayed jobs, job sites, etc., is another example of a bullet point under the nominal business impact test that could have or would have had adverse effects on a small business owner's ability to garner more gross receipts for that period than they would have without the mandates. And the nominal business impact test under these bullet points it's kind of like death by 1,000 paper cuts. So every one of these little adverse effects I would hope would add up to be potential more than a nominal effect on somebody's ability to garner more gross receipts without the mandates they would have relative to following those mandates. And these mandates are the rules that the federal government, state, city, county, local government would have been enforced in your area, in the areas that you would practice or in the areas that you do business during the periods of second, third, and fourth quarter of 2020 and the first, second, and third quarter of 2021. And you have to approach both tests, the revenue reduction test and the nominal business impact test, on a quarter by quarter by quarter by quarter basis. All right, we have the next slide, please. So what businesses could or commonly qualify, again, for the employee retention tax credit? And that would be any business that has a US EIN number. It would have to have W-2 employees, not 1099 employees, because the whole refund is based on wages that you paid, W-2 wages that you paid your employees during those 6 quarters. And I can't say necessarily that one type of business is more advantageous to having been clobbered by COVID than the other ones. I guess a couple like restaurants and health industry got hit pretty bad, but I vetted hundreds and hundreds of businesses from every way, shape, or form you can think of. But you never know whether a business qualifies or not until you really kind of dig into the interview process with the client that's going through the revenue reduction test using gross receipts, profit and loss statements, and then having personal interviews with the small business owner and or anybody else that had boots on the ground during 2020 and 21 that could actually attest to how their business was negatively affected relative to mandates they would have had to follow under the nominal business impact test. Now, the gross receipt test is pretty fact-based, assuming that the small business owner has a good set of books, obviously, because it's using relatively simple math to determine the 20% reduction or the 50% reduction in gross receipts. Now, the nominal business impact test is more of telling a story on how the businesses were negatively affected, requiring small business owners and their vendors to follow mandates. And then one thing that we really are very careful with is that clients may have been affected to beat the ban under the nominal business impact test, but you have to have documentation to substantiate that as well. You know, whether it's emails or statements from employees, or if you had supply chain issues, statements from vendors or vendors' records of percent of goods delivered, et cetera. So before we press the green light under a nominal business impact test, you have to have a good narrative, and you've got to have documentation to substantiate it. And the reason that we're so careful with that is that the current protocol with the IRS right now, when you file a claim for the employee retention tax credit, is they issue checks first and ask questions later. We always want to make sure that our clients are prepared for any type of audit or inquiry. That's what I mean by ask questions later. And the feds, the IRS, they have up to 5 years to ask questions later. So we tell clients, and we train them, also clients, on how to preserve that information and make sure that that small business owner's IT person, whatever, doesn't come in and press a Control-Alt-Delete and lose that documentation, because you need that documentation for an inquiry or an audit if there ever is one. Right now, I think there's 3.5 million claims filed the last I heard, and there's 300 trained auditors. So I don't think there'll be a lot of audits out there, but still, we always want to prepare for worst case scenario. I always tell my clients, if you can live with worst case scenario, you can live with anything, particularly under this program. We go to the next slide, please. Thank you. So again, does this business qualify for the employee retention tax credit? You have to have W-2 employees. You've got the 2 tests. You've got the the gross receipt reduction test in the center box there, the right-hand box. You've got the nominal business impact test. And you really want to make sure that whoever you have properly vet these claims, is that they do spend quite a bit of time with you and or your staff going through particularly the nominal business impact test. Again, it's a narrative, and you want to be very, very careful on that narrative to make sure that you've got enough, what I call bullet points of problem and effect, that you would feel comfortable that it exceeds what would be considered more than nominal impact on your business, and that you have the documentation, et cetera. I don't know about you folks, but even with my law firm, every single day, I get a phone call or an email or a text saying, you qualify for the employee retention tax credit. It's easy, sign up now. Well, it's not easy. And, when you're asking the federal government, to cough up as a tax credit anywhere between, $20,000 up to $10 million, you got to make sure that you have somebody that really properly vets this claim. If you go to the irs.gov ERTC site, the federal government has thrown up no more than 4 warnings to small business owners to be very careful who you have handle this claim. And I think the last warning they threw up, the IRS, they said use a tax professional. whether that's an accountant or a tax attorney to vet this. That's what I got out of the message there. So you have to be very, very, very careful. Some of these companies, from what I've heard, well, they're not tax law firms, they're not CPA law firms. From what I've heard, I can't attest to this, that they'll just tell you whatever you want to hear that you qualify. They'll file their claim. You get your check from the IRS, you pay them. You could be stuck with a horrible audit 2, 3, 4, 5 years down the road, or it's the type of claim that you never should have made. So again, just be very wary. Make sure that you use a business that's, well, like with tax attorneys, we're licensed, we're insured, we're regulated, we're accountable. So next slide, please. So again, we talked about the gross receipt reduction test and the nominal business impact test. And you can use one or the other test for any of the 6 quarters that you would have been in business during that period and had W-2 employees. We recap that. Go ahead with the next slide, please. And Captain Obvious, how can the ERTC benefit a business? Well, increasing cash flow. You can give those bonuses or wage increases to employees you may not already have been able to afford. You can invest in the growth of your business, and otherwise just set the money aside for possible storms, impending storms down the road. Next slide, please. So just as a recap on this subject matter, make sure if you're reaching out to this for the employee retention tax credit, I would recommend use a tax attorney. Oftentimes accountants are not in the know on the employee retention tax credit, particularly the nominal business impact test. And I've yet to see an accounting firm use the nominal business impact test. So just if your accountant does not do this, or they only use the gross receipt test, you may ask them to refer you to a tax law firm. And then just use common sense. If it's not a tax law firm, anybody that, if you see red flags going up, you're probably right. Just let your gut instinct captain that inquiry regarding any organization that's not a CPA firm or tax law firm. Terrible.